Hey, class, this is Dr. Sharma. I'm a professor of accounting at Elizabeth City State University, currently the chair of the department. And I've authored several books on accounting, published research in several outlets. I'm a member of several organizations just to keep myself updated with the current developments and the knowledge in my field. If you want to learn more about me, you can visit narendrasharma.us. You'll be able to see more information about me. Now, in this video, I'm going to talk about the recording of transactions. So that is the topic of discussions, recording of transactions. Okay. So that's what we are going to talk. And the first thing that we're going to talk about will be the characteristics of an account. So what is an account and what are its characteristics of an account? Okay, so that's number one thing. Number two, we are going to talk about journalizing the transaction. So this is journalizing the transactions. And then we are going to talk about the posting of those transactions into different accounts or the ledgers as we call them. And then finally, we'll prepare a trial balance. So at this point of time, we'll be preparing an unadjusted trial balance. So that is the agenda for this particular chapter. But of course, I'm not going to talk everything in this video. I'm going to concentrate on the first learning outcome. That's the characteristics of an account. So that is what we're going to talk in this segment. So first, let's start with what is an account. As you can see, account is an element of a record which shows the increase or decrease as a separate account. Each record in the books of accounts for any financial transactions or events having financial implications is known as an entry. Let me just take an example. Supposing this is your cash account, okay? Now, this is an element of a record in our books of accounts. Now, it will show increase and decrease in this account. So that is what we are going to talk about in this first element. Now, as I've been saying to you, first you need to understand what are the things that I'm going to put in an account. Only those that are considered as financial transactions. So that is number one thing that we're going to talk, financial transactions. And then next would be the events having financial implications. So those are the two things that we are going to include in our account as a record. So what is a transaction? Any exchange of value between two or more parties is considered as a transaction. And what is an event? Now, anything that happens in the business which has a financial implication is known as an event, and we'll be making a record of it. So, what is an example of a transaction? Of course, if I sell goods on credit or for cash, there is an exchange of value between the two parties, the customer and the seller. So, there is a transaction. What's the example of an event? An event could be a fire. Loss of goods, loss of property by fire would be considered as an event. Although there is no exchange of value, but nevertheless there is some lost value in that. So that is what we consider as an event. So those are the two things that we'll be making a record of. So if you're recording the transactions and events in the accounts, now as you can see, I just depicted a T account showing a cash account. So we'll be showing an increase or decrease in cash account. Now, we have learned the accounting equation, that is asset is equal to liability plus owner's equity. So we have been talking about that. So for each of these assets, liabilities, and owner equity accounts, we will be opening separate accounts. Now, that could be a general account. Like, for example, if it is a cash account, that's going to be a general account. Why? Because we are not talking of a cash with Wells Fargo or cash with, let's say, Bank of America or cash with, let's say, credit union. So that means if you are breaking that main account and opening several accounts for individual items, that is known as a subsidiary account. So I might have one account for Wells Fargo, one account for, let's say, Bank of America, and one account, let's say, for State Credit Union. And then if I add all of them, I will be getting a single account known as a cash account. So this cash account is going to be a general account. The other subsidiaries accounts are known as subsidiary accounts, as the name suggests. Similarly, you might have a plant and machinery. That's a general account, but you will have different kinds of machinery. So for each of them, we'll be opening an account. So that is a subsidiary account. So now, as you can see in this accounting equation, you have cash, you have accounts receivable, you have supplies, and you have land on the assets. And then on the liabilities side, we have accounts payable, and then the owner's equity, we have different changes to the owner's equity, because remember, we talked about that in the first chapter, that owner's equity will increase whenever the revenue is earned, and if additional capital is contributed by the owner, the equity will again go up. Any expenses will lead to a decrease in the equity account. So those are some of the elements that we'll be talking again. We'll be revisiting that concept again in this chapter when we talk of journalizing the transactions. Now, for now, what we understand is for each element of accounting equation, we'll be opening an account. That account is a general account if it is an overall account. If it is minute details of those components, then we'll be calling that as a subsidiary account. Okay. Now, we already talked about the transactions and events. What are transactions? Transactions are exchange of value between two or more parties. So there has to be an exchange of value, and it has to be between more or two parties. It could be a cash transaction or it could be a credit transaction. Whenever a credit transaction is taking place, then we create an obligation. Like supposing if Walmart sells something to me, I'm obligated to pay Walmart store. So that is an obligation created because of a credit transaction. But as we already talked about, what is an event? This is anything that has a financial implication or which needs to be reported by the company, that like depreciation or loss of goods by fire, or loss of goods or property by any other natural calamity will be considered as an event. Okay. So you can see we have opened a cash account. So in the cash account, on the debit side, that is the left hand side. Now please don't get hackled with the technical term. Debit side is the left hand side. So and the credit side is the right hand side. So that is what you will have to understand about that. So this is a debit side and a credit side. Okay, now we started with a balance of 1,000, and as I received 3,928, now because there was a fees that was earned by me, as you can see, that has increased my cash balance by 3,928. And again, I received some money, 3,700. That has also increased. So that's why I'm putting everything on the debit side. You can see those figures there. On the credit side, I have two payments totaling out to 2,255. And on the debit side, total is 8,628. If I subtract the 2, I get 6,374, 73. So 6,373 is the balance. Now, you have to always understand the balance will be, all assets will have a debit balance, and liabilities and owner's equity will have a credit balance. So that is something that you have to understand. But of course, within that also there is an element. So what we can do is we can break these out, completely take care of the transactions, and then look at the accounting equation later on. For now, you understand that if you have a cash account, I'll be putting all those items that increases cash on the left hand side and decrease cash on the right hand side. Take the difference between the two and calculate the balance. So that is a balance. Now, what we do is we open several accounts. All accounts that are opened and grouped together is called a ledger. That's another technical term in accounting. So all accounts, now in the past we used to have a kind of physical register kind of a thing, and then for each page you will have a separate account. So that is how it used to work. So we used to call this as a ledger, but now of course we will be having computer files, so that would be consisting of one computer file, would be probably a different ledger, or however depends upon the size. So it's divided into several pages with several separate accounts. In a manual system, in a computer environment, you could create a separate file for each account. So that is a ledger. Now, the next concept that we have to talk about in this segment is the chart of account. Now, chart of account is a numerical listing of all accounts that a company will be opening for assets, liabilities, equity, revenue, and expenses. Now, that is important for you to understand. We'll be opening accounts, so there will be assets account, there will be liabilities accounts, there will be owner's equity accounts, and then there will be revenue accounts, and there will be expense accounts. So these are the separate accounts that we open. Now, basically, it has become more relevant in terms of computer system, because you want to code, and most of the accountants like to use the numerical side of the keyboard rather than the alpha side of the keyboard. Therefore, they are coded in such a way which is easier for them to locate the information and input that information. So the balance sheet accounts are listed first. So now, as you can see, these are the three balance sheet accounts: asset, liability, and equity. And then next would be the income statement accounts are then listed in order of revenue and expenses. So that is how we will be organizing our chart of account. Now, what are assets? Because we studied that in the first chapter, let's just revisit them. Assets are economic resources belonging to the business. So now the assets are within the control of the business entity. Assets, of course, also represent probable future economic benefits. Supposing if I have a car, I can use the car to generate revenue in the future by traveling to different places and selling goods or providing services. So that is going to be my asset. But all these assets will have to be owned by you. So that is why we call it economic resources owned or in control by a business entity. Now, sometimes people get confused. Supposing if I have hypothecated a property and borrowed money, do I still control that? Of course, you have a control over that asset because you are entitled to use the asset as long as you pay, they continue to make payments for that loan. So that is going to be considered as an asset. So you'll have to record in two places. The part that you own will be asset, the part you owe would be the liability. So now assets can be both tangible and intangible. And tangible assets could be land, building, plant, equipment, supplies, inventory. Anything that has a physical form would be tangible. And anything that does not have a physical form, but it exists in books of accounts, that would be the intangible. Now, the value of these types of intangible asset is inherent in the legal claim for the future, either because we have a right to receive the cash or right to make use of the resource. So that would be prepaid rent, accounts receivable, goodwill, patents, copyright. All these will be considered as intangible assets. Now, the next component in the chart of account will be liabilities. Now, as you know, liabilities are claims over the assets by the creditors of a business. So, if supposing if I let's say buy a car for $15,000 and I put in 5,000 of my own, 10,000 I borrowed, this amount will be considered as an asset because I'm buying the car. Now, the amount that I have borrowed from the bank will be considered as a liability because the bank has a legal claim over that asset to the extent of 10,000. So that is what you have to understand about the liabilities. Liabilities could be in the form of accounts payable, notes payable, mortgage payable, any expense payable, or if you have received anything in advance before earning a revenue, that would be considered as unearned revenue and therefore a liability. The third element in the balance sheet is the equity. Now, as I just gave you an example, that $5,000 I put in to buy my car will be considered as an equity because that's the amount the owner has a claim over that 15,000 worth of car. So that is your equity, and equity have different terminologies. If it is a sole proprietorship, we call it as a capital. Even for a partner, we call it as a capital. But if it is a company, a corporate form of organization, we could have common stock and a preferred stock. So that would be the owner's equity in terms of a corporation. So whenever we are accounting for a different form of organization, we have to recognize that fact that we'll be calling it as a capital if it is a sole proprietor or a partnership. But if it is a corporate form, we'll be calling it as a common stock. Preferred stock are issued by corporations, but it's not very common. And of course, there is a difference between the two. We will be talking about it when we talk about the corporations in detail. Now, the next element in the owner's equity is the retained earnings, the amount which is plowed back. Plowed back means you have reinvested that money into the business to make more money is known as the retained earnings. As the name suggests, retained, that means you have kept it back. And earnings means the amount of money that you have made by running the business. So that will be, of course, net of dividends and any withdrawal if it is a sole proprietor or a partner. Now, a dividend account basically represents a distribution of earnings to the stockholders, and it could be considered as a withdrawal for a proprietorship or a partnership. So that is the third element here in the balance sheet. So we talked about these 1, 2, and 3. Now we are going to talk about the rest of the items. So now there are 2 more items. As you can see, revenue and expenses. Now, what are revenue? Revenue is the increase in the owner's equity and the assets of the entity because I have sold goods or provided services. If I sell goods or provide service in cash, I receive a cash amount, and therefore my asset will increase. If similarly, the owner's equity also increase because they are earning something. And then, if you are selling goods on credit, I will be creating an obligation that's known as accounts receivable. Again, that's going to be an asset. Okay, so that will be the revenue. On the one hand, cash received or a promise by a customer for sale of goods or services. So that would be, if you sell goods on cash, that's cash. On the other hand, it is a credit. So whether received in cash or an obligation is created, the benefit of the receivable is in the future. So therefore, it ultimately increases the owner's equity from this operating activity. So the examples of the revenue could be service revenue, interest revenue, that is the money that you have earned by investing your money or lending your money, fees earned by providing services, you would have earned some fees. Commission, based on if you're working on a commission, any amount of money that you receive would be a commission revenue and rent revenue. Those are the examples. Now, next element that we're going to talk about are the expenses. Expenses are product expenses or period expenses. There are two kinds of expenses. Product expenses are, of course, they both result from using up of the assets or consuming the services in the process of generating the revenue. We'll not be calling them expenses if we are not using them to generate the revenue. Examples of the expenses: cost of sales, administrative expense, selling expense, distribution. Now, they could be salaries, wages, rent, utilities, supplies, miscellaneous. All those could be your periodic expenses. Cost of sales would be the product expense. I'm buying something to sell it to someone else, like Walmart store buys all those commodities on their shelves from someone else and sells them off. So any amount of money they pay for those will be cost of the sales. All right, now next thing we are going to move on. This is an important concept. Accounts are numbered by their account type. So you have to understand that concept very, very clearly. That is, if you are having an asset, that number will always start with 1. If it is a liability, it will always start with 2. If it is an equity, it will always start with 3, and then 4 will be the revenues and 5 will be the expenses. So these are the numbers that we use to denote what kind of an account is it. So each type of account is numbered using the same first digit. Asset always begins with 1. So it could be 1, 101, 1001, or 1,000,001. And then liabilities will begin with 2. So accounts payable could be 201 or 2001. And similarly, loans would be 2004 or something like that. And then stockholders' equity will begin with 3, and revenues with 4, and the expenses with 5. So that's the numbering system. So as you can see, this is a typical chart of account for Charles Law Incorporated. They have cash. Now, you may wonder why we are using 11 rather than 100. So it all depends upon how many accounts you might have in your list. So if you have a big company, probably you might start with 1001 or maybe 1,000,001 if you have several assets account. So that's how we decide on the digits. Okay, so but remember that all assets will start with 1. And the liabilities, as you can see, have started with 2. Stockholders' equity have started with 3. And revenues have started with 4. And the expenses have started with 5. So that's how we organize your chart of account. Now let's just review, and then we'll wind up for this segment of the class. In a ledger, a separate account is maintained for each type of asset and liability, for each element of owner's equity, business transaction, business day, or journal entry. So, what is it? Now, as I said to you, we'll be opening accounts for each of the elements of the accounting equation. So that is asset, liability, and owner's equity. So number A would be the right answer. Number two, a distribution by a corporation to its stockholders on a basis of proportional to each investor's percentage ownership is. Now, as touched upon briefly, any distribution to the owners in a corporation is a dividend. So that would be the D would be the answer. Now let's go on to the next. Assuming the company uses 3-digit code for the following accounts in the chart of accounts, and they are the first items on the list. Write their chart codes assuming standard coding practice. So what will it be? Now, as you can see, always asset will start with 1, liabilities will start with 2, equity will start with 3, revenue will start with 4, and expense will start with 5. So if it is a 3-digit code and that's the first number, so depreciation expense will be 501. How about inventory? Inventory is an asset, so I will be considering that maybe as 101. What is a dividend? Dividend is part of the equity, so it has to start with 3, so it could be 301. And sales revenue, which is a revenue, therefore it has to start with 4, so therefore it would be 401. And accounts payable, of course, is a liability, so it could be 201. So that is how you will be handling the numbering system for different assets using the code. So that is all that we'll be doing for this segment of the class. So I'll be seeing you in the next presentation. So that's all for today. Thank you very much for listening to the presentation.